Alrighty. Once again, this is the Ideas You Can Trade webinar. My name is Jeffrey Baskin. I am joined by my esteemed colleague, Stephen Hatzakis. Stephen is the author of the daily blog, Ideas You Can Trade, and he's going to be presenting to you guys today not only how to read, interpret his Ideas You Can Trade, but also we're going to be going through some live examples in the market. Before we do that, as always with any webinar, we do have a risk disclaimer. Worldwide Markets believes that customers should be aware of the risks associated with over-the-counter market. In the OTC market, a retail customer trades directly with the counterparty, and there is no exchange or central clearinghouse to support the transaction. The over-the-counter market is highly speculative in nature, which can mean prices may become extremely volatile. Since low-margin deposits are only typically required, an extremely high degree of leverage is obtainable in OTC trading. A relatively small market movement will have a proportionately larger impact on funds that you have deposited. Since the possibility of losing your entire cash balance does exist, speculation in the OTC market should only be conducted with risk capital that you can afford to lose and which will not dramatically impact your lifestyle. Thank you very much for providing that risk disclaimer, Steve. That was quite encompassing for everything. I will turn this over to you. Actually, before we do that, I would like to just go over Steve's bio so that you know a little bit more about him, and then I'm going to turn it over to Steve so that he can talk to you more about his Ideas You Can Trade. We will leave time for questions and answers for everybody, so please, if you do have a question, just save it until we get to the end of the presentation. In the meantime, if you do have a question about what we're talking about specifically, please type it in the chat box and we will try to address it as we go. As I said, Stephen Hatzakis is the author of Ideas You Can Trade. You can find that on blog.worldwidemarkets.com. Steve has been trading in the foreign exchange market for nearly 16 years. He was the former VP of institutional sales at a U.S. regulated FCM for almost 9 years. He is registered with the NFA as a CTA, which is a publishing-only registration. He has contributed to over 130 different financial publications and is an editor for Forex Magnates. He has authored over 150 Ideas You Can Trade posts on the Worldwide Markets blog. So I am now going to turn this over to Steve and let Steve kind of do his thing and give you some more information about Ideas You Can Trade and how you can benefit by using these. You ready, Steve?
Yes, I am. Thank you so much, Jeffrey, for the introduction. And again, hello, everyone. Thank you for joining. We're going to start by going through a little bit about the background of how this series evolved. You know, what was the idea behind creating this series? I'm just going to take a moment to transition to share my screen with you so that you can see both the presentation as well as the platform that we're going to be showing you, which is going to be, you know, using live rates, and we're going to go through the process of how I create these posts every trading day except for Sunday and, you know, certain holidays. So I'm just going to take a moment and just get this screen shared. Just give me 1 second.
There you go. I can see your screen. Just go to full screen and you should be good to go.
Okay, excellent. Okay, can we see, does everyone see the full screen?
Yes.
Okay, great. So I'm just going to move forward to the slides that we had gotten to. Basically, Jeffrey read through the risk disclaimers. These are important. I just want to echo that, you know, these ideas are not meant to be investment advice or, you know, trading signals. They're really, you know, rather designed to stimulate awareness of potential trading opportunities, because a lot of times traders will look for trading opportunities and in my opinion, trading opportunities exist, you know, almost all of the time. It really depends on what your perspective is on the market, you know, what your investment methodology is about, your trading strategy, you know, your risk reward, your overall, you know, trading methodology. It's going to be different for everybody. So for that reason, although there could be, you know, millions of trading opportunities out there, it's going to be different for everybody. So these posts that we make here are not meant to be, you know, exhaustive of all the trading opportunities, but rather just one subjective opinion to help stimulate awareness. And then by doing so, you know, traders will be able to develop their own trading ideas over time. So just going through this slide here that you see about ideas you can trade. Again, the ideas are not to be misconstrued as trading advice. Every trader must take their own responsibility when they trade, you know, to use their own discretion as to, you know, whether they're going to trade or not, what they're going to trade. You know, they have to take full responsibility on that. Unless you're giving someone power of attorney or a letter of direction to manage your account, as traders, we always have to be responsible for our trades. So moving forward, the background of this series was born out of the idea of, you know, using technical analysis. Technical analysis is just one way to look at the market, and, you know, the challenge is that you're looking at the history of the price. So a lot of people say past performance is not indicative of future results. While that's true, you know, the assumption with technical analysis is that you can have a better probability of determining possible future trajectories. But at the end of the day, nobody knows where the market's going. You know, it could go up, it could go down, nobody knows. But at least by using a combination of technical analysis, fundamental analysis, you know, this is all based on efficient market hypothesis, on the weaker model of the hypothesis, that, you know, everything's connected over time. So I like to use support and resistance levels, but I tend to use the dynamic support and resistance trend lines, which are trend lines that are either ascending or descending. They're diagonal as opposed to the static horizontal trend lines. So we're going to move forward and just skip through this bio part that Jeff already introduced, and I'm just going to, you know, pass it on to Jeffrey for a moment so he could introduce every slide here, just to give you some idea on the things we're going to talk about.
Yeah.
Jeffrey, can you just chime in?
Basically, the next step in the process is to look at the ideas you can trade and dissect them, so that when Steve does put these out on a day-to-day basis, you can, you know, see what he's talking about and understand, you know, these are the key elements that he's looking for when he comes up with his ideas that you can trade. So this is just an easier step-by-step process on how you can break these ideas down and make better use of them in your daily Forex analysis.
Thank you so much, Jeffrey. So on this slide here, you know, what we're trying to do is explain the best way that someone could make sense of these posts. Again, this is just one perspective, so everyone might have their own way of discerning the information. But in my opinion, I think that the key steps to help, you know, best understand these posts would be to first look at the major trend theme across the whole chart. So the first thing you're going to look at is, okay, if the chart, let's say, is a medium-term chart, let's say the, you know, the last 365 days worth of data, the past 12 months, what is the major theme? Has it started lower and is now higher? Is it mostly bullish? Has it started higher and is now lower, mostly bearish? Or has it zigzagged, you know, back and forth? Is the trend mixed? But you don't want to just look at that medium-term view. You also want to look at shorter time frames. So, you know, you might look at the past 3 or 4 months. What has happened during the past 3 or 4 months? Did it, you know, diverge from one channel into a new one? Did something change? Did it reverse on a key resistance line, or did it bounce off a key support level? And then once you've done that, you know, you have one view, you have the second view. Now you want to look at the latest price action. You want to see, you know, what's happening now. So it's important to understand the latest price action, because that's what's relevant. You know, you're not trading in the past. You're not trading what happened 3 months ago. You're trading, you know, possibly what's happening today. So you have to look at today's price action as well as the last few days, because normally the last few days may have a more impactful influence on today than just a few months alone. So what I mean by that, for example, there could be huge volatility in a currency pair, and the next day that volatility might continue. Whereas if the currency pair has been flat for the previous few days, it's likely that it may continue to be flat unless some big news comes out or some major technical level was breached. So again, the first thing is to look at the major trend across different time frames. The second thing is to understand the latest price action, the most recent days, and how that might affect the next move. And then to connect all of this together. And that's what I try to do with the posts. I try to connect what's been happening across multiple time frames within one given chart. And then I talk about how these may continue, how they may persist, or how they may change the next trading day or the current session. So I normally talk about these aspects in the posts. In the beginning of the post, as you'll see, and you can see this on the blog as well. In the beginning of the post, I talk about what's happening now, the major trend themes across the chart. I try to connect these all together, and then I talk about what might happen next in both ways. Again, I'm not making a call in one direction or the other. I'm actually saying if a trader is going to try to trade this currency pair or CFD, if they want to go bullish, they might do this. If they want to go bearish, they might go do that. So if they want to buy, they're going to be bullish. If they want to sell, they're going to be bearish. And then looking at the slide in front of us, after you've looked at the major trends, you understand the price action, you've connected it, the next step is to decide whether you want to trade or not, and if so, in which direction. Theoretically, you could do a trade in both directions, but that would complicate things, as you would have to take into consideration a potential hedge or how the stop loss orders on both trades would offset each other, as well as the limits, depending on which got hit first. So that's a more complicated question that I'd be happy to address later on, if you'd like to contact us and learn more about that.
Yeah, that's a webinar for another day, Steve.
Yes. So finally, if you decide to trade, whether it's based on an idea in this series, on one of the other ideas that we have on the Worldwide Markets blog, for example, the Today's Trading Edge by Edward Moya, Worldwide Markets technical strategist. Basically, no matter where your trade idea is coming from, whether you read something in a magazine, heard it on the radio, or through your own analysis, you should always choose a stop risk level for your stop loss order and a limit level for your for your risk reward. So you want to have a stop loss and a limit on your trade, so that God forbid something happens, if your internet connection drops, if your electricity goes out, at least your trade is protected. And you also have to consider, this is the most important thing, you always have to consider the gain to loss ratio or the risk reward ratio. What that means is you have to look at how big the stop is, stop loss, and you have to look at how big the limit is. And generally, the limit should always be bigger than the stop, because over time, over 1,000 trades, if you're risking more, if your stops are bigger and your limits are smaller, or if the size of the loss that you realize is larger and the size of your profit is smaller, then that's a recipe for losing money. So you want to do the opposite. You want to have your winners bigger, your profits have to be bigger on average than your average loss. So this is one of the most overlooked things, because I've seen many successful traders give back all of their hard work, hard-earned money from trading on one big loss, just because they didn't follow their risk-reward strategy. So having said that, we're going to move on to the next slide. I'll pass this on to Jeff while everybody digests this information, and then we can go through an example. Jeffrey, are you there?
Yep. Here is a chart of one of the ideas you can trade. This is a great example on the Aussie New Zealand. These are the types of charts that Steve puts up on the blog every day, and these are things, you'll see the text and the lines to help you get a better understanding. And those of you that may be a little bit intimidated, Steve's going to walk you through exactly how to read this so that you can start to use these charts for some of your Forex analysis that you're doing after reading the post.
Thank you so much, Jeff. So as Jeffrey explained, this is an example of the chart in the daily posts that we make on the Ideas You Could Trade series on the Worldwide Markets blog. So the chart is an important element of the write-up because it gives you a visual so you could connect that to what I've written in the post, to the text, which explains the description of the analysis. So in this example, I chose the Australian dollar against the New Zealand currency pair. So this is the Aussie-New Zealand pair, and I wanted to use this chart. I mean, I think I just chose it randomly, but it highlights that the recent price action had reached this orange line here at the bottom. I don't know if you're seeing my mouse here on the screen, but you could see that around this 107.26 level there had been support. It literally bounced off that level, and then it came back down. It hit again. It bounced again, but this bounce was short-lived. Actually, they call this like a dead cat bounce. So it came down really strongly on the very short-term bearish line. It bounced off this support. It bounced again, but then it lost its bullish bounce because the overall theme over the medium term, short term was bearish. And then it broke through this support level. After making the double bottom, the triple bottom wasn't able to hold, and it broke through. And what ended up happening is the pair moved even lower. So this was just an example. Going back to just a simplistic view of this, this chart is pretty busy. There's a lot of trend lines going on, so someone might look at it and it might be overwhelmed if they're a new trader, or even if they're a little bit experienced, because some people like to keep their charts very nice and clean. And although I'm a fan of nice and clean charts as well, I think it's important to take into consideration a lot of the previous trend lines, even though that's the past and that's already over, because those trend lines, as you'll see sometimes, will persist into the future. For example, the steeper medium-term bearish channel here in red, which was in play quite often, from April of last year through May, June, July, and towards September, before it broke out around this level here, right when it broke above the long-term bearish support, the dark red line. When it broke out of that, then this medium-term bearish channel became support until it finally exited that. But the reason why I'm saying all this is because eventually, even though that was no longer relevant, if you see below that I've continued the trend line all the way down, and now the price action may be returning there again. So for that reason, I like to have a lot of lines on the chart because, yes, I agree, sometimes it could be confusing. However, I think that if you look at each part separately, you read the analysis, you look at the points that I mentioned about, which I have numbered and I've color-coded, to help identify them more easily, you'll see that sometimes these, trend lines from the past will actually persist into the future. So having said that, let's move on to the next slide. This is just an example of the MetaTrader platform, and here you have, again, I think it was the Aussie-New Zealand pair. Actually, in this version of the chart, as you could see, the pair is much lower because I think it was taken a few days afterwards, maybe yesterday, when the pair had already dropped through. But the vertical line you could see here in blue was when I had covered it on the Worldwide Markets blog, and then after that it dropped lower. And now it's in very bearish territory, as I had explained on the Ideas You Could Trade post. So moving on to the next slide, what we're going to do is we're actually going to go through some further explanation. But let me just move back to this slide. Sorry about that. We're going to take a few minutes and just switch to a live look at the Forex market. And I'm just going to need maybe 10 or so seconds to bring up the MetaTrader platform, so I'll just pass the mic over to Jeffrey for a moment while I get the MetaTrader platform from Worldwide Markets ready so we could do this live, okay?
Perfect. Thank you, Steve. Yeah, Steve's going to bring up his MetaTrader 4 chart so that we can take a live look at the market. While he's doing that, Does anybody have any questions about what Steve has covered so far? Any questions as far as the posts themselves or how to read them so that you can better understand what he's about to talk about as he goes into the live look at the market here? If you have any questions, please go ahead and type them into the chat box. All right. Does not seem like we have any questions coming in, so everybody should be understanding what you're talking about. So why don't we look at the live MetaTrader 4 charts that Steve has up here, and he can walk you through some of what he's looking at now, live in the market.
Excellent. Thank you so much, Jeffrey. And I'd like to tell everyone that if there's something you missed or something you didn't understand that I said, you can always contact me with specific questions and contact Jeffrey as well. We're going to provide our contact information at the end of this webinar, and a copy of this recording will also be posted on the Worldwide Markets blog or website so that you could review it again afterwards. But in the meantime, we would encourage everyone to prepare their questions. We're going to dedicate some time in a little bit for a Q&A session. So I'm just going to take about 5 or 10 minutes and just go through almost every currency pair here.
We do have one question come in before you get there. Okay. It asks, how timely are the posts, and when are they posted, and how long is the viewpoint valid given the active movements of the Forex market?
Okay, I may need you to repeat the last few questions, but let me start with the first one. So the first one, as far as how timely they are, when I'm doing the analysis, I'm doing it on live charts, live prices, which update in real time. And when I am preparing to make the post, in the beginning of each post, you'll see that I always say, right now the currency pair or the CFD is trading at, and I'll put the specific price, or I might say, as of publication, or it's trading near this level, like 172.15, like the Japanese, the British pound against the yen, GBP, JPY. But the moment I click post, there may be a few second delay, so it might be, 1 or 2 pips off. But again, I always include that it's around this price, as of the time of publication, because the price has changed so quickly that literally when I click to make the post, whatever delay there is between me clicking and me typing in the price in the post, the price probably will have changed. But it's as far as how timely they are, they're pretty timely. I mean, it's not going to get more timely than that unless it's like some automated kind of signal, which we could talk about as well, as Worldwide Markets does offer automated signals as well through a third party. So I hope that answers that question. Can you tell me the other 2 questions?
Sure. How long is the viewpoint valid given the active market movements in the Forex market, and then what time of day do you post these?
Those are 2 great questions. So first of all, I would say that the viewpoint could. The viewpoint would be accurate so long as the levels are not triggered. For example, the bullish and the bearish trade ideas are normally, a certain degree away from the current market price. For example, it might be 50 pips above the current market price, 50 pips below, but it could be as much as 10 pips above the current market price, as in yesterday's post. So it really depends on the currency pair. But generally, to answer the question, as long as the buy order or the sell order has not been triggered as far as the levels in the example, then I would say that the trade idea could still be valid in terms of if somebody decided to copy it. Okay, again, these trade ideas are not meant as trading advice or as live signals, but rather as trade examples. Now, if somebody wanted to trade them as real trades, they could, mimic them and copy them, and they would still be valid so long as the entry prices had not already been reached. Because if the entry prices were already reached, then you would no longer be able to enter at those prices because the market would either be above or below those levels. And then as far as the third question, generally these posts are made, between the London and I would say the close of the London session or sometimes during the latter part of the New York session. So it could be any time from like 16 GMT to 22 GMT, and occasionally it might be at the start of the Sydney session, in Australia right before Tokyo opens. So I would say that the posts are mostly between the end of the London session, beginning of the New York session, sometimes at the start of the Sydney session, but not often during the Tokyo session.
Okay, we do have a few more questions.
I hope that answers that question. Is there anything else?
We do have a few more, but let's get into the live charts, and then we'll answer the rest of the questions at the end of the session.
Okay, great. And everybody, please feel free to keep pumping those questions through, because during the Q&A session, we're going to spend at least 10-15 minutes to go through questions. So feel free to send them in the meantime. Okay, so here we are with the MetaTrader platform. Can everyone see that platform?
Yes.
Okay, great. So this is using a live account at Worldwide Markets. This is the Worldwide Markets MetaTrader 4 platform, and in addition to the other platforms that we offer, I tend to use this platform as, for me, it's easier to conduct this type of analysis and save the charts and the trend lines. But we also have the Alpha Trader platform, which we just launched, which actually does have a lot of fantastic capabilities. So I would suggest you look at that as well if you're looking at our platforms in addition to this one. So as far as the way I do the ideas you could trade posts, every day I scan through the different currency pairs, and I look for, the latest price action and whether it could be interesting or not. So before we go through all these, I just want everyone to know that, again, there could be multiple trading opportunities each day in multiple pairs. And since I only post one, it's not meant to be the only opportunity. So the way I choose which one to post is really arbitrary and subjective and based on my discretion. So, it's not always indicative of the biggest potential price action. For example, if we look at the euro, we could see that it moved pretty pretty higher today after trading within a range over the last few sessions. We could see it bounced off this long-term. It bounced off this line, which was parallel to the long-term bullish resistance line here. So again, this is just an example. What I'm going to do is I'm just going to take a few minutes to go through all these charts to show you. So here we have the pound yen. This has been in an uptrend for quite a while. I was looking at it when it was around this level here, and I had a feeling that drawing trend lines from the past here, this green line up here, that it could possibly move higher up to that level. I hadn't wrote about it. I was actually trading it personally, but that's actually what ended up happening. So that's an example of how a trend line, that seems like it's not in play at the moment, could come back into play as the longer term trend theme comes back into play. So now we're going to move to the Swiss franc. Again, this chart looks very busy. There's a lot happening. This is an example of a chart that's kind of mixed, because it started around here, but then it's gone up, it's come down, it's gone up, it's come down. It's kind of zigzagged, but it shifted from this blue bullish channel, and it diverged back into this this white dotted line bearish developing channel, which I actually had anticipated if you look back at my previous posts around this time. I'm sorry, go ahead, Jeffrey.
Can you discuss how you use the ARC channel? It's not something that you see every day on a chart. So
yes.
That?
So this, yes, thank you for pointing that out. It is an interesting channel, and what it is exactly is it's a regression analysis. It uses 4 different types of regression. It uses exponential regression, logarithmic regression, quadratic regression, and linear regression. So these are all different mathematical methods of calculating regression, which states that over a given sample of data, prices tend to come back to an average. So when we look at this red line, It's basically over the past 370 days, because this is a daily chart, and it's calculating those four types of regression over the 370 candles, and it's giving us this red arc because this is the regression, and the middle of that arc, which is a white alternating dotted line, and that's going to be the median line of the regression channel. It's going to be the middle of the channel. So basically, prices will, what this channel is doing again is it's showing you the high, not necessarily the highs and the lows, but the average highs, the average lows, and kind of the middle of it. So right now, in the latest price action, the dollar Swiss has reached the high of the regression channel, which could be said to be resistance, and now it's dropping. But it's important to note that as the new prices update, the slope of the arc, the slope of the channel is going to change. So, you know, it's not like this channel has looked like this, you know, for forever, you know, for the duration of this chart. It's going to constantly change. Like, for example, back during this bullish session, this bullish time period, the long-term bullish channel here in the first half of the chart, that same channel, the red one, would have been sloping upwards. So I hope that answers the question, Jeffrey?
Yep.
Okay, perfect. So now, getting back to the analysis, we're just going to go through other currency pairs, but I think you get the idea that this is an example of a mixed chart where the trend diverged from being bullish and then into a bearish slope as, you know, the direction changed. But a lot of the previous lines are coming back into play to some degrees. And if the previous lines don't continue into the future, sometimes they stop and they repeat. Like, for example, on this chart, if you look at the number 2 short-term bullish lines and channels on the bottom left here, number 2, if you see the mouse, the slope of this channel has generally repeated itself. I mean, this slope here, the first one, is not as bullish as far as the angle, but the other ones, like these two and these lines here, they're almost identical in their slope. So that shows you that, you know, such a line could happen again. So, like, we could move that line and show you that, you know, it happened again here. Okay, and that's another reason why I have all these colors here and the description for each point. It's because I tend to see them repeating again, and this way I can consider them likely things to repeat. So here we're looking at the pound US dollar, and after we go through these currency pairs, I'll show you an example of a history of like one specific pair on the blog, because every time I cover a currency pair, you're able to see the history of that pair as we link each article to the previous one. So again, same thing here with the pound. If you look at this number 3 very short-term bullish trend line, this type of duration and angle has repeated multiple times within the context of a medium-term bearish channel, which is this green channel here, which, you know, brought the prices higher, and then it exited that channel into this purple one here, the less bearish channel, and then it had steeper bearish drops, which were yellow, short-term bearish drops, and then again you see this short-term, very short-term steep bullish trend line repeating as the, you know, pound against the dollar has been on a very steep bullish ascent, you know, having gone from 147, roughly 147.90 area here, up this channel. Then it came out of the channel, but it resumed the direction, and now it's back making new highs today. So that's just an example. The way that I would, you know, choose a trade idea, like, you know, just going back to the pound, for example, if this was something I would cover, I think the last time I covered it, it might have been where this vertical line is. I'm not sure, but generally I have my chart saved, so that's one way to tell. I would draw a trend line. Okay, let me just... I had minimized these windows here for the purpose of the webinar, and just need to throw this back again. Okay, so we're going to get to that in a second.
It's the line studies.
So basically, yes, exactly. So if we were to, you know, choose the pound USD today to analyze, you know, we'd look at the latest price action, okay? But before we do that, we'd look at the overall theme. So, you know, it came lower, bounced a little bit. The main theme was the long-term bearish resistance, but it also had medium-term bullish support here after it fell below that line, and then it recovered. It again, as we discussed before, it made its way up this this channel, and then this green line came back into play here. If we draw this resistance here, it actually met resistance there, diverted, went back higher, had resistance here at 166, which it just broke through today. So again, looking at the latest price action after we looked at the overall theme, we could see that the past few days it's been on this bullish ascent on a line similar in slope to the previous very short-term steep bullish trend lines. So that's an example of how, you know, I would carry out, you know, this type of analysis. If we looked at the previous highs during this day, we can see that on the 2nd of January, the high was 165.92. It was just under the 166 level. Maybe that was psychological resistance, and the pair wasn't able to break above it for whatever reason, and then it came back down. But eventually, it resumed the upward momentum, and it just broke above that today. So I would say that if I were to do a trade idea on this today, that, you know, if it fell below this level, that I would go bearish, because that would be a false breakout, and that if it was able to move higher from here, that might be, you know, a very bullish move. But at the moment, you know, we're right there. We're right on 166. So although it's still bullish, you know, you're still a little uncertain maybe. You're not sure, is it a false breakout, is it a real breakout? But I would say that the trend is still very bullish here. So I might do a trade idea, you know, with the entry at 166.20, you know, and to take profit at 166.50, 166.70, and then, you know, with the risk below this 166 level. So that's how I would play that. But we also have to look at the previous lines and how they might come into consideration. Okay, extending that line, for example, we could see that, you know, if this did continue higher, it could possibly meet resistance, you know, on that green line that I just drew. Normally I do a dotted line if it's less certain, you know, versus something that's already been proven as far as the trend line. So, okay, I don't want to spend too much time on this. I think I've made it pretty clear, just giving a couple of examples of the points of how, you know, I do the analysis there. Again, it's not meant to be exhaustive, but when I try to choose a pair, I will generally scroll through, you know, the different currency pairs. Here we have the dollar CAD, which I covered yesterday, and it actually moved even higher again today, which was, you know, I'm not surprised to see it move higher like this, given how steep the recent bullish price action has been. And this is an example of, you know, how the long-term bullish resistance line here might be a target and might come back into play, you know, drawing it out from way back from August 2013.
Can we jump into the blog and go over the specific examples that you have?
Okay, great. I just switched over to the blog. Can everyone see this? Okay, we should be seeing here January 17th post of gold. Just let me know, Jeffrey, if everyone could see that.
Yes, it's on the screen.
Okay, great. So this was a post that we did on the Ideas You Could Trade series for gold, which is a CFD that Worldwide Markets offers in addition to other CFDs like metals and different indices. So gold was chosen because it appeared to have been reaching this rose-colored resistance line. And I thought that this could be a level where it would either reverse if it was resistance, or it might actually break through to the upside, which could be very bullish. I also provided a longer-term perspective just to give everyone a different view of, look, yeah, there could be a bullish move upwards, but the overall trend has been very bearish. I mean, gold had like its worst year last year in like 20 years, I think, considering it dropped from after almost making a new high above 1800. So in this post, in the beginning of the post, I give you, first of all, the name, what's happening, ideas you can trade. Gold closes on bullish setup under resistance. This post was actually made Friday afternoon when the market had already closed, and it had closed at 1252.75. It had closed there on Friday afternoon in New York, and I have a link here to the last time it was covered. So if here we have the explanation of what happened since the last time it was covered. I also mentioned that it was recently covered by Worldwide Markets technical strategist Edward Moya in the Today's Trading Edge, which is another series we offer. And then I talk about what happened, what's new, what's the recent price action, what's happening now, and what I think might happen next. And then you have the trade idea, if a trader is going to be bullish, how one way they could possibly play it. And this includes, a stop and a limit, as well as what the gain to loss ratio is, or the risk reward, which you take by dividing the potential profit by the potential risk. And when you divide one by the other, you get a ratio which shows you, the profit relative to the risk. So moving forward, if we look at this link, the link is going to be to the last time it was covered. Okay, so take a look at the chart. Now, the last time it was covered is in this post, which was on January 6th, okay, a couple weeks before. There was a mini flash crash in gold, a big price anomaly that happened, worldwide as a result of some huge order. I talked about this here, and also I posted to the previous article. So what I'm getting at is that every time I make a post for a specific currency pair or CFD, unless it's the first time it's being covered, you can see the entire history because every single post is linked to the previous post. Okay, I'm just going to skip through. The first time I covered gold last June, you could see that the bearish channel in red was pretty much in play. First gold had ascended up this green line, this support line, but after it failed to break above this bearish resistance, the upper side of the channel, it dropped really, really, significantly over a couple of month period down this purple short-term, medium-term channel. So that red channel has been the major theme, and as you could see in subsequent posts, it remains to be the theme. Afterwards, actually, it almost broke below. It actually did break below, but then it recovered after that. This is a much longer-term view here over the past few years using a weekly chart, where we could see gold, almost broke the inflation-adjusted highs of, this 1970s, I believe, when it reached, just below 2000, and then it had the big drop last year. And then again, afterwards, it was covered in August. Again, the red medium-term bearish channel, which has now become like a long-term channel, during that time it had met resistance, multiple lines of resistance. The yellow line was resistance, the teal line was resistance, the red line of the medium-term channel was resistance. So in a situation like that, if it breaks above, it's going to be very bullish. If it fails to break above, it might reverse. So that's basically how I tend to look at, the charts and how I do the analysis, and how you can look at them too. You can see a history of everything I've posted, article by article, as they're all linked to each other for any given instrument, as well as just explore through the blog or click on the keywords to find related posts for the different currency pairs. So here I have linked all the gold posts that I've made. There's a total of 1, 2, 3, 4, 5, 6, 7, 8, 9 posts of gold that have been covered, so far since I started covering it in the series last year.
I'm going to open up the floor.
I don't want to take too much time on this section.
I'm going to open up the floor
Okay.
to questions, Steve. We're actually starting to run out of time here. We don't want to take up everybody's entire day. One of the questions that has come in is, do you use trend lines only, or do you also take a look at chart patterns?
Absolutely. I think, there are so many studies that you can use today, from pivot points to Fibonacci levels to, different type of candlestick patterns, dojis, hammers, inverted candles, shooting stars. I think that, or even, just regular pennants, symmetrical triangles, asymmetrical triangles, flags. There's many different type of chart patterns, even others that are more mathematical, different type of indicators, MACD, moving averages. I mean, there's literally hundreds and hundreds of studies that can be used in technical analysis. In that aspect, I like to keep it really simple. I like to use the dynamic trend lines, which I consider, to be support and resistance lines. They're just not, horizontal, because I think that the dynamic lines, the horizontal ones, are in play more often because the prices are constantly changing. When markets are sideways, yeah, the horizontal support and resistance, which are fixed to prices, might be in play more, but I tend to use the dynamic ones because I think, those trend lines are constantly changing over time as far as the price. They're not fixed to a specific price. But I like to use both dynamic trend lines as well as static support and resistance lines. But to answer the question specifically, that is pretty much 90% of my focus. From time to time, I'll draw a Fibonacci retracement line in there, and then I might leave the Fibonacci retracement line on the chart and not update it on purpose. For example, with the dollar CAD example that we showed before, just yesterday, the big move that it had was actually on a 161% Fibonacci level, which, if you're only drawing the 0 to 100% line and then updating it every so often, you might not see that. But I had drawn the 0 to the 100% retracement, and I had left it there. So many weeks later or months later, as the currency pair moved higher, it eventually reached the 161% level. So again, these are really things that are different for each technician, for each analyst, for those of you using technical analysis. It's really a matter of preference. I look at it as an art more than as a science, but in reality it's both, because it's left brain and right brain. You need to use the objective approach as well as your subjective interpretation of it. So I hope that answers the question. Again, I don't use any other indicators. I mean, I showed an example of the quadratic linear regression. That's one that I do like. But as far as moving averages, I'm not a big fan of using moving averages, but I think they're important and I think they can be used. But some of my charts are already pretty busy, so I don't want to overcomplicate them by throwing in too many further indicators. I'm more of a fan of the trend lines, as I mentioned.
Okay, we're going to take 2 more questions. I have them set up. This is a bit of a long question, so just hang in there here. Hi, Stephen. Good presentation. Thank you. You spoke about gold. When brokers make markets in spot gold, is all the gold that is spot traded actually mined and physically present somewhere? Or is it just like a paper trading game where only the prices are linked to the price of physical gold and there is no real gold to back up all the positions? Many thanks for answering this.
That's a great question, and although I might not have the entire answer, I remember reading a few days ago on the Foreign Policy Journal website regarding potential price manipulation of gold by even the U.S. Fed allegedly. I mean, I'm just telling you what I read, and they noted that on the COMEX, which is an exchange where physical gold is traded, that if everybody wanted to take delivery, that there might not be enough bullion, stored to actually make delivery, and that's a pretty serious problem. Most of the gold traded actually is done in London on the London metals market, where first of all, more volumes trade there, and people actually can take real delivery. I mean, when you're trading a physical commodity, there's storage costs involved, there's delivery costs involved. These things are sometimes factored in to the futures price and into the contract or the cost of carry, depending on the kind of instrument you're trading, the exchange you're trading it on, and whether or not the contract is cash settled versus whether you can exercise it and actually get gold delivered to an authorized gold warehouse. So to answer your question, when you're trading with worldwide markets, okay, you're trading in the over-the-counter market as far as the OTC products that worldwide market offers. Worldwide market also offers through third parties, exchange traded products such as U.S. equities, but you could learn more about that on the website. As far as the OTC products, when you're trading gold, you're basically trading a CFD. So a CFD is a contract for difference. If you look at some of the posts that I made on the Worldwide Markets blog in the Ideas You Could Trade series for gold, for example, there's a link at the bottom of some of the posts regarding CFDs, so I would encourage you to look at that and learn more about that. But to answer your question, you cannot take delivery on a CFD for gold. So yes, you are trading a paper contract, and that contract is based on the underlying price of gold. Of course, there could be a difference because we're using futures to adjust for the price when the market's closed, or even during the live market price. You're looking at the spot rate. The spot rate of COMEX could be slightly different than the spot rate of other gold exchanges where the commodity is physically traded. So normally brokers are going to use a combination of sources to price a CFD so that the pricing could be as accurate as possible. But at the end of the day, when you're trading CFDs, you have to remember that it's over the counter, there's counterparty risk, and you don't own the actual underlying physical commodity. So there's pros and cons to both. If you wanted to own gold, you could buy a futures contract and take a delivery, or buy the actual gold from a gold dealer and store the bullion somewhere safe. Or you could trade a CFD if you wanted to use leverage to speculate on the price. So it really depends. I think every product, every instrument has its own place. I spoke on a panel once in New York regarding over-the-counter markets versus off-exchange markets. Again, there are pros and cons of each, but it's important to know the difference. So I would encourage everybody to read through the Worldwide Markets Customer Agreement, the risk disclosures, the examples about CFDs that we have on our website. We have a PowerPoint that explains about that. But again, I hope this answers the question. A contract for difference is not the underlying product that it seeks to replicate or trade. It's really just a vehicle for speculators to be able to use that price to speculate on and potentially use leverage as well.
Thank you, Steve.
Okay.
All right, we're gonna wrap this up. So if you have any other last comments, Steve, feel free. And then I would like to give out everybody's contact information as well as a special offer that we have from Worldwide Markets. Thank
you. I would like to just read through this slide here just to remind everybody. I know I'm not telling you something you don't already know, so pardon me if I'm being redundant, but I think no matter how long you've been trading, it's good to remember that really nobody knows which way the market's going to go. And if you look at it from that type of untrusting perspective, you remind yourself that nobody could be too sure of the direction. However, if you have a trading strategy that incorporates a proper risk-reward ratio, and a proper risk-reward ratio is going to be different for everybody. So it really depends on your unique, goals, the time of the day you trade, your risk tolerance, your financial situation. It depends on so many things. So, the explanations here are not meant to be complete or exhaustive of every possibility. And I just wanted to read through this. I may be more bearish or bullish sometimes in the posts, or sometimes more neutral, and that's because sometimes I might be more optimistic of a trend or less optimistic, or I may express my opinion in that manner. But at the end of the day, traders have to take their responsibility when they trade, and they decide whether or not they're going to trade. So I just want to remind everybody of that, because again, this is something subjective, and everybody has to use their own discretion for that. And again, past performance is not always indicative of future results, but if you look at that differently, past performance may be indicative of future results, but not always. That's the key difference. So even though the trend might be strong, as soon as someone jumps into the trade, it could go against them. And that's why I just wanted to remind everybody that nobody knows for sure where the market's going to go, but if you have the right strategy, the right risk reward, that at least you can protect yourself to a degree, so that if the market goes against you and you get stopped out, at least it was a level that was predetermined. At least you anticipated that this was the amount that you were willing to risk. First, on the other hand, if you're right and the limit gets hit, then that's the level that you were planning on taking profit. And by having the right risk-reward ratio, if you repeat this over thousands of trades over the course of a few months, a few years, whatever, that hopefully at the end, the outcome that you'll have is going to be in line with the goals that you have planned. So that will be it from me. Again, I just want to move on to the last slide before we wrap this up, and thank everybody for joining us. And I mean this sincerely, that we value your feedback, whether it's good feedback or bad feedback. I think there's no such thing as bad feedback. So we welcome your criticism, whether it's positive or negative. We want to improve this series, and I think that by getting feedback from you, we'll be able to best iterate it to help optimize it for your likings. So thank you so much, and we look forward to answering any further questions that you may have. If we weren't able to get to your question today, we'll try to respond to you individually via email. Thank you so much, and I'm going to pass it on to Jeffrey.
All right, thank you. Here is everybody's contact information: Stephen's email, my email, the blog where you can continue to read ideas you can trade. And we do have one special offer from Worldwide Markets. Steve, if you can go to the next slide, please.
Sure, here you go.
Thank you. If you currently don't have an account with Worldwide Markets, what we're offering is for you to trade for free for your first 30 days with Worldwide Markets. Open an account, you make a deposit, and then you'll receive a rebate back into your trading account for any trading spreads that you traded up to $250. So this will give you an opportunity to test out Worldwide Markets if you currently don't have an account. So just open the account, and we will cover your trading spreads for the first 30 days that you have your account open, up to $250. If you currently have an account with Worldwide Markets, if you make an additional deposit of $2,500, we will extend you the same deal, and you can trade for free for the next 30 days up to $250. So basically, we'll cover your spreads, just trade on your profits and losses, and you'll get a redemption back into your account at the end of the 30 days. In order to redeem this, please contact myself, Jeffrey Baskin, jbaskin@worldwidemarkets.com. That is all. Stephen, thank you very much for your time this morning. We appreciate it. We look forward to reading your ideas you can trade on the Worldwide Markets blog, blog.worldwidemarkets.com. And we're going to try to hopefully get you to come on again maybe another couple weeks and do another live webinar.
Thank you so much, Jeffrey. A big thanks to you as well for helping to organize this. And I want to thank everyone also. And I just want to add one last thing. You can also subscribe to the Ideas You Could Trade series on the blog so that you receive them via email. But I will say that there can be a greater delay in getting the email than seeing the posts on the blog. So we would encourage you to look for the posts on the blog as the email may come a few minutes afterwards. But again, thank you, and I'll be happy to join again on a subsequent webinar. Thank you again, everyone, and thank you, Jeffrey.
All right. Have a good day, everybody, and good luck with your trading.